Welcome, everyone, to another deep dive. Today, we're tackling a question that's probably crossed your mind if you've ever thought about growing your wealth. Where should you put your money for the long haul? We're really digging into that age-old debate. Stocks versus real estate. We've got some excellent source material here laying out the data on both sides. Our mission today, let's unpack what the numbers truly reveal about these two, really popular investment avenues.
That's right. People often have strong feelings, strong intuitions, maybe about real estate or stocks. Could be influenced by personal experiences or, just headlines you see. But what's fascinating here is that we'll look beyond those perceptions. We're focusing on what the historical data actually tells us about long-term returns and other crucial factors, too. We're going to help you cut through some of that noise and get right to the core insights.
Okay, so let's set the stage a bit. Both real estate and stocks are, they're incredibly popular ways people try to build wealth. You hear stories all the time, right? Home values just shooting up, especially with that really hot demand we saw globally in recent years. It inflated values everywhere, even if things have cooled off a bit now. And then you've got stocks also seen as, a traditionally safer bet for long-term growth. So it really poses the central question, doesn't it? Which one has actually performed better over the long haul?
Yeah, and this is where the data we looked at gets really interesting. It doesn't just suggest an answer, it kind of shouts it. Our sources let us do a direct comparison, going right back to the start of 1995. So if you take the Case-Shiller home price index that tracks house prices in major U.S. cities, broadly speaking, it's up by just over 310% since then.
Okay, 310%. That sounds pretty decent on its own.
It does, but here's the kicker. Contrast that with the S&P 500 index. Over the exact same time frame, it hasn't just risen, it's surged by more than 1,200%.
Wow, 1,200 compared to 300.
Exactly. And this is really critical if you factor in reinvested dividends for the S&P 500, which is, let's be honest, how smart long-term investors operate. The total returns actually blow past 2,200%.
Whoa, okay, hold on. Over 2,200% versus just over 300. That's not just a difference, that's a massive gap that completely changes the narrative many people have about real estate being the ultimate long-term play. That's pretty staggering.
It really is. Now, look, it's true that, specific housing markets vary. A house in San Francisco isn't the same as one in, say, Detroit. And individual properties can certainly do better or worse. But when we take this broad, long-term view comparing the asset classes overall, the stock market has pretty clearly been the significantly better investment. It really counters that common wisdom.
But then, you hear these stories. People talk about their real estate profits, and they sound absolutely incredible. Like someone bought a place for X, sold it for Y, made hundreds of thousands of dollars. Why does that perception stick so firmly if the data shows stocks are, blowing it out of the water on percentages? What are we missing there?
That's a really good question, and it comes down to, I think, scale and maybe a bit of psychology. The reason real estate profits feel so huge is often because the initial investment itself is so large. You're buying a house, you're often talking hundreds, thousands, maybe over $1 million in some places, right?
And a huge chunk of change.
Exactly. So even a, let's say, decent percentage gain on that kind of principle, it translates into a really big raw dollar profit figure. It's eye-popping. But, and this is the key distinction our sources make, when you adjust for the size of that investment,
right,
when you look strictly at the percentage return on your capital, the story changes a lot. That's when stocks start to look much, much more favorable from a pure growth perspective.
Okay, so let's run that hypothetical then. Using the S&P 500 example from the source, say someone put, $500,000 into an S&P 500 tracker fund for 5 years. What kind of profit are we talking about, roughly, using that long-run average return? You mentioned about 10%.
Yeah, the sources peg the long-run average at around 10% annually for the S&P 500. So $500,000 invested at 10% for 5 years. You'd be looking at a profit over $300,000.
Over $300,000. Okay.
And if you scaled that up, say, to a $1 million investment, that profit jumps to over $600,000 in just 5 years. So you see, stocks can absolutely generate those really impressive eye-catching dollar profits too, if the initial investment is significant.
Right. It's just that the percentage gain is likely much higher.
Precisely. And that feeds into the power of compounding, which the sources also highlight. With that kind of average annual return, that 10%, after 10 years, your money is up more than 2.5 times. Let it run for 20 years. It swells to over 6.7 times what you started with.
Wow.
That's that exponential growth just quietly doing its work. It's incredibly powerful over time.
That is powerful. But it feels like it's not just about the return percentages, right? Are there other factors the sources point to that also kind of favor the stock market.
Oh, absolutely. You're right. It's not just the raw numbers. There are several other really practical advantages. First, let's talk liquidity. Big one.
You meaning how easily you can get your money in and out?
Exactly. With stocks, buying or selling, it's usually a few clicks, almost instant, minimal cost. Real estate, oh, well, it's famously illiquid. Selling a house takes time, effort.
Oh, yeah. Realtor fees,
Yeah.
closing costs, inspections.
Right. It all adds up, and the whole process can drag on for months. Very different experience. Second big factor, diversification. When you buy a single property, even maybe two, you're concentrating a huge amount of your capital into one specific asset in one specific location.
Yeah, all your eggs in one, maybe slightly leaky basket.
Kind of. Your investment success is tied very tightly to that one property and its local market. With stocks, especially if you use something broad like an S&P 500 index fund or ETF, you're instantly diversified across 500 of the biggest U.S. companies, different sectors, different industries.
Spreads the risk out massively.
Hugely. It insulates you much better if one company or even one whole sector has a bad run. So the sources really conclude that this combination, better historical returns, much better liquidity, and far superior diversification, generally makes the stock market the safer and more advantageous long-term strategy for most people.
Oh, okay, that makes a lot of sense. So for you, the listener, hearing all this, maybe you're thinking, all right, I get it, but stock market investing sounds complicated. Where do I even begin? It's a practical, maybe less intimidating way to actually apply this knowledge.
Yeah, that's a fair question. A really straightforward approach, especially if you're new or just want broad market exposure without picking individual stocks, is to simply track the S&P 500 using an exchange-traded fund, an ETF.
An ETF.
It's basically a basket of stocks that trades on an exchange, just like a single stock. You buy shares of the ETF. By buying an S&P 500 ETF, you effectively own a tiny piece of all 500 companies in the index. You get that instant diversification. You track the market's performance, usually with very low fees and minimal complexity or risk compared to individual stocks. It's a very accessible starting point. So if we pull all these threads together from the sources, yes, real estate can generate some really impressive dollar figures, mainly because the initial bets are so big. But the data, when you look at it comprehensively, focusing on long-term percentage returns and factoring in critical things like liquidity and diversification, it strongly suggests the stock market, particularly through a diversified approach like the S&P 500, has historically been the more advantageous path for building wealth over the long term.
That seems like a pretty clear takeaway from our deep dive into this material. It definitely shifts the perspective, doesn't it? Moves you away from just those big headline dollar numbers to understanding the underlying percentage growth, the flexibility, the risk reduction. So as you reflect on this information, maybe think about what steps you might take,
Yeah.
How does this align with your own financial goals and strategy?
Right. And it does raise an interesting further question, something maybe to think about beyond just the numbers. How much do individual circumstances, your specific goals, your tolerance for risk, maybe even how much active management you're willing to do for each asset, how much do those factors play into an investor's actual long-term success? That's a whole other layer, isn't it?